So you then add another clip around 41. All the time you're thinking, right, 44.5 is about the maximum risk I'm going to be taking on this trade. There we go. We snap through 39 really quick. This fast drop is just what you're looking for. You got this very quick drop straight through 39. That's saying to you, right, the move is on. The snap through the level is everything that you want, because that says to you the market's being controlled by sellers. This is a trade that I call a caught in the hole situation. Now, with a caught in the hole situation, this allows you then to essentially go against the crowd. The structure tells you this is weak. However, that's just the profile structure. You've then got to formulate a plan. You've got to formulate a process for how you're going to look at this and assess what potentially can happen. This is crucial to how you execute and how you plan any day trade. It's not about wait for a setup and execute. It's about understand what's likely to happen and then look for a situation that allows you to play for that. We've got the caught in the hole situation. Now I've colored these red, orange, green, green being the most likely, red being the least. So you know that the more likely trade is a reversal here because value hasn't shifted. And so straight away, this then says to you, right, well, you can trade this in a certain way. Your first thought is I'm looking for a short, and a short from the open could well be the trade. But you're also waiting for the market to show you that the trade is actually playing that move, is actually starting to drop. Once you get that, now you've got confirmation, and now you can be confident that this is a reversal and leverage your trade up. We could have a balance day though. And so with this being a balance day, your strategy here would be that in order to shift value up, the market has to balance at higher prices. And so then you could play this as a short with the expectation that we're going to get a small drop and then a rotation back up, and the market then just trade in a range at the high. Continuation is highly unlikely. So continuation, the only way you're going to get this, you need to see the market trading above the previous day's high. Then you can start looking for a continuation pattern higher. One of the most important things whenever you're taking on a trade is to give yourself options. Trades aren't just a simple binary choice of I will do this here and this here. The situation, the structure says this is what can happen. Now give yourself an option. So first option is what I call a simple version of this trade. If you're trading this in the S&P, which is where this trade comes from, simple trade is you sell on the extended trading hours open. Stop goes above the previous day's high and you wait. Targets back to the value area high, back to the VPOC. The VPOC being the highest volume traded point of the previous day. So they'd be your theoretical two targets, these purple lines. This has its advantages. It's very clear where your risk is. You're in from the beginning of the move, so you get a decent payout. What's very hard with this trade is to know that you're right, because at no point does it suggest you are right until it moves to target. The alternative version of this is that you wait for what I call the confirmation version. This is a way of taking the trade once the volume comes in when the regular trading hour session opens. Once this happens, if you are going to get this reversal back to value, the flow is going to drive the market there. And so now you get a sense that, yes, the structure suggests it's going to happen, but now the market's showing you it is going to happen. And this is key. So this is the point where you can leverage. So yes, you're going to take less out of the trade. You may take 2/3 of the size of tick move, but you could do this on 4, 5 times the size. That's where the real value comes, because those technical traders who understand where their edge is in understanding this reversal and the positioning maximize this trade by leveraging this as much as possible and extracting those ticks out of the market with as big size as they possibly can. If you take the first option, you sell it. This gives you a 16 big tick risk on the trade, which for some people they're not going to be overly keen on. That's $800 per contract, but you do get a payout all the way down towards the top of the previous range and then all the way down towards VPOC. This realistically would be the main target for me. Always looking at a point where others could come and buy from. If you looked at this technically, you could understand why someone would buy from here. The hard bit about that trade is that takes 16 hours to work. And most of those 16 hours are spent meandering sideways and marginally lower. If you wait for the regular trading hours where the flow comes in, the volume comes in, we open the regular trading hours at 52 and we move straight down. 45 minutes, you achieve the target. So there's 16 hours or there's 45 minutes. And that makes a massive difference because when you can see that the trade is already in play, now you can be very, very confident. And once the trade's asymmetric, you know that you want to be trying to leverage this up. So how do you leverage these types of trades up? We know the structure. So you know that profile trade now. You've got the caught in the hole. Expectation is we're going to roll it straight the way back towards value the next day. This is a high probability trade. It's one of my favorite profile trades. One of the many that I've got sort of in the locker that we teach everybody. So how do you maximize these trades? The key to maximizing trades is leverage. And just to illustrate the power of leverage, this shows you the performance win rate of our technical trader. Over the first half of this year, his win rate is about 50-50. And if anything, it's slightly less than 50%. This is the difference between professionals and amateurs. It's not about looking for win rate. It's about leveraging the situations that make sense. It's about maximizing those trades that are going to work. Let's go and have a little look at what exactly this trade is. How do we take the trade on? This trade is what I call an opening range breakout. And the key to leveraging any trade is threefold. First up, you've got to understand what can happen. This is your technical structure. We've covered this. We know where the market can go. Next up, though, is you now need to understand when that's going to happen. And when is not a case of at some point today. It's about being able to say, now's the time. I've got an expectation that I want to see a certain type of flow here. And if you see that flow, now you know that the trade is on. The time is now. And so that's when you can take the trade on. And then finally, you need an understanding of your risk. Once you can define your risk clearly, and once the opportunity becomes asymmetric, this is where you leverage. So let's go and have a look specifically at how to leverage up this caught in the hole trade. This is the move from the regular trading hours open. It's what I call an opening range pressure build. So what we've got, whenever you get a market opening, so the main regular trading hours, you will establish what I call an opening range. This is the first low and the first high established. So typically this can be within the first 5 to 10 minutes. Once you've got this, and this range in this instance runs from 42.52 to 42.39, we're already trading below the overnight low. So the market is already tipping over towards the downside. Remember, your main target is down at 41.96. So within the move, then we get a test of the top of the range up at 52, which comes in just up here. And then the point where you can execute this trade is where rotations get smaller as we start to fall. This is just one of many order flow strategies that you can learn. And we teach numerous of these throughout the course. But this is a way of playing a breakout. So what we're looking for here is as the market falls down the range, rotations are going to get smaller. The market is going to build pressure into the low. And once it snaps, once that pressure creates the break at 39, now you know the trade is on. This is where you can leverage up. This is where you can maximize your position. So not just go from one simple trade, one simple position and wait for it to work. This is now saying, right, everything that you're looking for has happened. Now that you've seen it, you need to execute. You need to build the position up, maximize this trade and wait for the play to run out. Like I said, the simple trade took 16 hours. Once you get into this trade here, you can take your full size in 20 minutes down towards that target, which is around about 50 ticks. Right. So let's go and have a little look at how this trade actually plays itself out. So price then skips up and down. Your price is the point between the bid and the offer. So this is a market that is reasonably stable. We're skipping for around about 46 up towards 48. Reasonably stable market at this point. Next up then, how's it moving? And this is what the last traded quantity shows you. This little white box that skips up and down, this shows you the last orders that traded through. And what you're crucially looking at here is the speed with which this box moves. The speed and the consistency of direction is what matters. So if you're in this situation, we're trading around 46, mid-range. You know that really you want to be in on the break of 39. So You're then watching the market, planning out how are you going to do this? Are you just going to sell it below 39? Or are you going to be watching out for something that gives you a clue beforehand? Now, when we started, we were looking at 46 to 48. We've just now pushed 46 down towards 43. So, reasonably quick move. This is where you start looking for an opportunity. And what I'm looking for then is the market to stop the rotations towards the upside. We move 46 to 43. And now you see each time we bounce up, we stick around 44 and a half. The next push down gives you the first opportunity to sell. So this is where you take on your first position. Just one clip. So if this is 2 contracts, 20 contracts, whatever your standard size is. So you can get in there. And note now, the rotations are getting smaller and smaller and smaller. We bounce back towards 41 and a half. So now seeing this, we're following this similar rotation down. This is where you can add again. So you then add another clip around 41. All the time you're thinking, right, 44 and a half is about the maximum risk I'm going to be taking on this trade. And next up, it's about preparing for the break of 39. Once 39 goes, the move is on. At this point, we're not certain that it's going to work, but as soon as 39 breaks, you can be very confident that this is going to work. So there we go. We snap through 39 really, really quick. This fast drop is just what you're looking for. Just pause it there very briefly. You got this very quick drop straight through 39. That's saying to you, right, the move is on. So what you can now do is get the rest of your size on. And then trying to do this, be willing to chase this down a little bit. The reason that you're willing to chase this down is we shouldn't be coming back above 39. So if you can get your position on down here, your average price is already above 39. So you're in a great situation here. As long as it's staying below 39, you're in a good position. The important thing now is to leverage your trade up. And so we're now in a situation where you should be building the size into this as much as possible. So be willing to move your orders down. Get in as long as you know that your stop is still above 39. The trade has essentially now become asymmetric. So part of the position pulled down, we get a part fill on another part of the next order as well. So we've now got up to nearly 4 clips into this trade. Brings that offer down once more. But now you can be confident on the trade. The snap through the level is everything that you want because that says to you the market's being controlled by sellers. The low volume that you see up here is a further illustration of this. And I've talked about this on previous videos as well. So at this point, we've now got almost your entire position on, your entire size on the trade. Still though, watch out for the rotations. Where are we rotating back to? Because if we keep rotating back towards the same area, that 34 and a half, this is where you can now start to look for another entry. So anything that comes back up here, this is now the chance to just passively get any last bits of your size in. It's not about looking at this and thinking, whew, I'm on side, time to sort of hold back and relax. You're now thinking I'm on side, time to maximize your position. Get as much onto this trade as possible because this is where you're going to get paid. And so once you've got 4 clips on your trade or 4 clips into your trade within a small area, you've done 4x your normal size. You're now in a situation where realistically, you're going to struggle to lose on this trade because we shouldn't be trading back above 39. So if you trade back above 39, the trade is wrong. It is not a breakout. If we don't trade back above 39, you can then hold this on the basis that we now have an asymmetric situation. What I mean by an asymmetric situation, you have a low chance of losing and you have a low cost if you do lose on this trade. So we're now in prime position. All you've got to do now is let the move go. You've done the hard work of getting in. Now it's time to get paid. So on this trade now, it's just a case of working out where your stop can be. To start with, you've got this low volume higher up. We shouldn't really be getting back towards this low volume. So if you want to be really, really cautious on the trade, you can actually minimize risk to a degree at this point. Reduce your size down by having a stop up here. It may not get hit, but it will then bank some profit if it does come back. But ideally, you're now in a perfect situation to hold on to this trade, to look for the next 35 full ticks towards the downside. So you can now place a stop 36 and a quarter for half the position. You then place a stop above 39 for the other half. This way, you'll bank and put yourself into a situation where you're not going to lose on this trade. The only disappointment will be if it comes back and you end up not taking as much out of it as you would hope. But we're now in a situation where this is unlikely. You're in a great position. You've leveraged your trade up. This is now the time to get paid. Sit back, let the trade happen. That's the difference between professionals and amateurs. Amateurs will look at this and feel that they've got themselves in a nice position and they're quite comfortable with this situation. Professionals are looking at this thinking, how can I really get paid on this trade?